Today we are going to discuss about deferred tax assets and liabilities. We are going to understand what are DTA and DTLs. We are also going to review an example and we are going to see how it is treated in accounting standards and in tax books. Okay, so there's an important note here. It says IT department calculates tax as per its own rules and not as per the rules of FR, which is financial reporting. So the IT department has their own methodology for calculating taxes and taking in consideration and treatment of various balance sheet and income statement items. Before we dive into deferred tax assets and liability, we must understand some basic terminologies. Let us go through this. The first one is accounting profit. This is similar to this is nothing but the income before taxes we see in income statement. It is accounting profit is just another term for pre-tax income. The second comes taxable income. Taxable income are the income which are subject to income tax under tax laws. So this is the part of the income which has to be paid to the income tax authority. The third comes the income tax payable. This is nothing but the income tax, the amount which has to be paid to the tax authorities, that is the taxable income into the statutory rate. The statutory rate is decided by the tax authority or it is defined in the tax code and rules of conduct. It is generally done as per the taxation accounting. And this next comes tax expense. Tax expense is the tax liability according to the accounting standards adopted by the company or an organization. In case of India, it might be Indian accounting standards, or in case of US companies, that is generally US GAAP or IFRS. The other is income tax paid. This is nothing but the actual cash outflow which happened during when we pay income tax to the income tax authority. The other two is very important. It says tax base and carrying amount. The tax base of an asset is the amount at which the asset or liability is valued for the tax purposes under taxation accounting. And the carrying amount is the amount at which the asset or the liability is valued according to the accounting principles. It can also be said that tax base is the economic benefit which has to be realized over the period of time, so that the uh, depreciation is accordingly adjusted with the tax base, and the value of the particular asset or liability is comes to uh, at par with carrying amount. The next is current tax asset and liability. Current tax asset. Current tax asset is the amount recoverable in taxes. It is generally the advance tax we pay to the tax authorities. And the current tax liability is just a vice versa of it. It is the amount which has to be paid or which is payable in taxes. The current tax liability also shows the current taxable income, that is, the amount which has to be paid during the current fiscal year. The current tax asset is the refund received on current taxable income, or we can say that it's just an opposite of the current taxable income. Since we pay current taxable income to the tax authorities, and since we have already paid an advance of that current taxable income in the previous year, we receive a refund on that particular particular tax relief. So this is current tax asset and current tax liability. The next come the main point, which is deferred tax assets and liability. DTA and DTL generally arises because the accounting standards and tax authorities recognize the timing of taxes due at different times. It might happen that the as per the company, when the company reports accounting standards, it may use different methods of depreciation, impairment, or the provisions, and the tax authorities may have allowed different or certain limit or cap to the particular treatment of that items in the taxation or the accounting. So there's a difference arising. The difference which arises due to this is known as which is settled with the deferred tax assets and liabilities. These are nothing but temporary differences which occur due to distinct treatment of various items, as I said. For example, under accounting standard, a company may use 10% straight line method of depreciation, whereas tax authority may allow 20% double declining method or straight line method for that particular asset class. This timing difference will eventually reverse over the asset's depreciable life with deferred tax asset or deferred tax liability. We are going to see an example very soon so that you will understand it more thoroughly. The changes in deferred tax asset and deferred tax liability are added to income tax payable to determine the company's tax expense, which is shown under the income statement. We'll review this point after we go with the example. So here are some common differences and formal definitions of deferred tax assets and liabilities. Let us go through this once. So deferred tax liabilities occurs when financial accounting income tax expense is greater than the regulatory income tax expense. We can say that when the accounting profit is generally higher than the taxable income, we are bound to have deferred tax liabilities. And vice versa goes for the deferred tax assets. The formal definition says when financial accounting income tax expense is smaller than the regulatory income tax expense, we have to have deferred tax assets. We can also say that there's are temporary differences which is created, which are offsetted later on, which are offsetted in later years. So there's one important formula to be keep in mind while calculating deferred tax assets and liabilities, which is income tax expense is equals to tax payable plus changes in deferred tax liability. Or you can also use another formula which says income tax expense equals to tax payable minus changes in deferred tax assets. We will thoroughly use this formula in our next slides, which is going to be an example. So the example says a transportation firm acquired a fleet of pre-owned buses for $90,000 with a 3-year useful life and no salvage value. The buses are estimated to generate $60,000 of annual revenue for each of the 3 years. The firm uses straight line depreciation method for accounting purpose and double declining balance method for the tax purposes. The given tax rate is 30%. We have to compute and calculate the deferred tax asset or liability for 3 years as a result for the different depreciation method which are given and used. So I think by now we are very much familiar with the financial accounting statements, and here it is given $60,000 of annual revenue. So the revenue comes same for the all the 3 years, that is 60,000 for year one and two and three. Since we are using straight line depreciation method for financial accounting, it is simple to calculate. Uh, since there is no salvage value for that particular asset and the useful life of the asset is 3 years, we are bound to have $30,000 as a depreciation expense for each of the year. The pre-tax profit comes to $30,000 as we deduct depreciation from the revenue. So $30,000 is same in all the 3 years, and the tax expense which is given at a rate of 30%. When we calculate 30% of 30,000, we get 9,000. So the net income for the year one, two, and three comes around $21,000. Now comes the tax reporting part. Under tax reporting, we have to use double declining balance method for depreciation. The revenue comes same for all the year, that is $60,000. And I hope you all know that the formula for double declining balance method is 2 into cost of assets upon useful life. So it comes around $60,000 for the first year, $20,000 for the second year, and $10,000 for the third year. The taxable income for the first year comes around zero, because since we deduct depreciation of 60,000 with the revenue of 60,000, we get taxable income at zero, and we don't have to pay any taxes on the taxable income of zero, so the net income comes to be zero. Similarly, for year two, the taxable income is $40,000, and when we calculate 30% of tax paid, we get net income of 28,000. And similarly, for year three, we get $35,000. Now we calculate the tax. Now we calculate the tax expense and tax payable to determine the changes in deferred tax liabilities. What causes this temporary difference is the difference between tax expense and tax payable, which is settled by deferred tax liabilities. For year one, as we can see, the tax expense is $9,000 and there is no tax payable. So we get changes in deferred tax liability of $9,000. Since we are starting, since there is no any more information regarding the beginning the deferred tax liabilities, we are bound to assume it to as zero. And when we put this change in deferred tax liability of 9,000 using previous formula, I hope you all remember, which is income tax expense equals to tax payable plus changes in deferred tax liability. We get ending deferred tax liability as $9,000. For year two, we have tax expense of $9,000 and tax payable of $12,000. So we get a negative change in deferred tax liabilities, which is 3,000. And when we the ending DTL of year one is same as the beginning of the year two. So when we add change in deferred tax liabilities of negative 3,000, we get $6,000, and the opening $6,000 for year three, we calculate changes in deferred tax liability as the tax expense minus tax payable, which is $9,000 minus $15,000, and we get negative of changes in deferred tax liability, which is 6,000. So as you can see, after uh, after putting the values in that that particular formula, we get ending deferred tax liability of $0. This way, we end up with the deferred tax liability of zero for the buses at the end of the third year, which shows a temporary difference we created to adjust the accounting for the financial accounting and tax reporting system. Uh, Also, it is not compulsory. It is also there is some shortcoming for this particular method. Besides being tedious and very long to calculate, it will be actually very difficult to estimate the deferred tax liability if the revenue for the subsequent years is not given. Hence, we use tax base and carrying value method. Let's save it for some other day and we'll cover that in another video. Thank you and have a great day. If you guys have any doubt, please feel free to comment below.